Hello friends, welcome back to another video. Friends, this is the second video of our series of mock tests where we are covering Indian economy and Indian financial system paper of JAIIB. Now in this mock test, we are covering module B, that is economic concepts related to banking. Friends, as I have said earlier, that JAIIB exam these days is all about concepts. Those who master concepts, only they can clear JAIIB. Rest all will again make the excuses that paper was tough and out of syllabus or out of the textbook. So in every mock test, I focus only on concept building. And so is with this mock test also. Let's see in short what concepts I will cover in this mock test. Now first we will start off with the concept of types of economies. Then we will do a case scenario on analyzing a competitive market with simultaneous shifts in demand and supply. Next we will do types of inflation with special focus on stagflation. After this we will focus on the concept of equilibrium based on ISLM model. Now friends, this is very important concept with respect to your examination. Next we will understand the concept of phases of business cycle. After this we will do a question on FRBM Act. Then we will also do a case scenario on assessing economic welfare using multiple metrics. After this we will do a numerical and understand the concept of primary deficit. And after this we will do a case scenario on interaction of monetary and fiscal policies. Friends, please note all these are very important concepts with respect to module B of your paper. Especially this equilibrium of ISLM model and how monetary and fiscal policies interact. So don't miss out these questions from today's mock test. But before we start, don't forget to get your JAIIB Masters pack from the link given in description to this video. Now this is the pack of 4 books. All these are 1000 series question banks of IEIFS paper, principles paper, accounting paper and lastly retail banking and wealth management paper. Now all these books contain super special 1000 plus questions which are very important for your examination. All the books contains real exam level questions and that too with updated difficulty level. These are chapter wise question bank, so it's easier for you to finish this in a step by step manner. Not only this, these question banks comes with lots of case studies and numericals and that too with detailed solutions. And the best part of these question banks is that you get my full support with respect to any problem or issue you may face in these question banks. All the links are there in description of this video, so don't miss out on these amazing books. So friends, without further ado, let's start with today's mock test. And the first question covers the concept of types of economies. And the case study goes like this. A central bank in a small, open economy is confronted with the challenge of managing capital flows while stabilizing the domestic currency. In response, it adopts a dual approach. First, introducing capital controls to limit speculative inflows and outflows while simultaneously raising interest rates to curb inflationary pressure. Despite these measures, the economy experiences a slowdown in exports due to a strengthening currency leading to trade deficit. How might the conflicting objectives of capital flow management and currency stabilization impact this economy's overall macroeconomic performance, and what further policy adjustments could be considered? Now these options are given to you. Now first option is, the capital control could successfully mitigate volatility, but higher interest rate may depress investment, requiring a shift towards exchange rate targeting. Then second option is, the interest rate hike could stabilize inflation, but the trade deficit might widen, necessitating tighter fiscal policy and export incentives. Then third option is, the currency stabilization efforts may reduce inflation, but capital control could lead to liquidity shortages, requiring increased foreign reserves and a shift towards monetary expansion. And last option D is, the combination of capital controls and interest rate hikes could balance growth and inflation, but fiscal policy tightening may still be needed to manage the trade deficit. Now friends, the correct answer for the question is option B. That is, the interest rate hike could stabilize inflation, but the trade deficit might widen, necessitating tighter fiscal policy and export incentives. Friends, please note raising interest rates, as mentioned in the case, typically strengthens a country's currency, which can control inflation, but this makes exports more expensive, thereby reducing demand abroad and thus leading to a trade deficit. Next, friends, there is also a mention of capital controls. Friends, while capital controls might help stabilize capital flows and protect against speculative attacks, but the adverse impact on exports could nullify the benefits. Therefore, tighter fiscal policy along with targeted export incentives like subsidies or tax relief becomes essential to sustain export competitiveness and address the trade imbalance. So friends, I hope the explanation is clear to you. Next, let's see why other options were incorrect. Now, option A suggests shifting towards exchange rate targeting. Friends, please note while this strategy could address currency volatility, it could nullify the purpose of capital controls and interest rate adjustments aiming at stabilizing inflation and managing capital flows. The next option C argues that capital control could lead to liquidity shortages requiring monetary expansion. But friends, this contradicts the high interest rate strategy aimed at curbing inflation. Not only this, expanding the monetary supply could fuel further inflation as well. And lastly, option D assumes fiscal policy tightening could manage the trade deficit effectively. But friends, without export incentives, the export could suffer from lower demand and slower growth rate due to reduced competitiveness in global markets. So friends, I hope the question is clear to you. The next question covers the concept of analyzing a competitive market with simultaneous shifts in demand and supply. Friends, equilibrium of demand and supply is a very important concept from this unit. And the second question goes like this. In a perfectly competitive market for electric vehicles, a sudden increase in battery prices, that is input cost, occurs simultaneously with a government incentive that raises consumers' demand. Which of the following best describes the impact on equilibrium price and quantity? And these options are given to you. Now friends, in a perfectly competitive market for electric vehicles, an increase in battery price, which is in fact a key input, will cause the supply curve to shift left, like this. Now this is because higher input costs reduce producers' willingness to supply the same quantity at existing prices, and thus leading to reduced output and upward pressure on the equilibrium price. Simultaneously, the government's incentive to promote electric vehicle adoption boosts consumer demand and thereby shifting the demand curve rightwards. That is like this. Now friends, please note here the government's incentive might include subsidies, tax rebates or other benefits making electric vehicles more affordable and attractive for the consumers. Now friends, when both the supply and demand curve shift simultaneously, as you can see in this diagram here, the direction of the equilibrium quantity change depends on the relative magnitude of the shifts. Now friends, I hope you all know that point of intersection of demand and supply curve gives the equilibrium point. Now in our case, while the supply constraint would normally reduce quantity, the stronger demand due to government support could offset this effect, thus leading to an overall increase in the equilibrium quantity. Now since the supply curve has shifted left and demand curve right, there is likely an upward pressure on the price resulting in an increase in the equilibrium price. Thus the most probable scenario in the market is that both the equilibrium price and quantity increase. So as far as this question goes, the correct option is option B. Now friends, before moving ahead, don't forget to subscribe this channel since this is the only channel that provides quality content. Also join my Facebook group where I post lots of one-pagers, mock questions and other useful stuff which is very important for your examination. You can also join my Telegram channel and Instagram page as well. All the links to join are there in description of this video, so do join after you finish this lecture. Then next question is from the concept of types of inflation, and the case goes like this. A country experiencing high inflation observes the following changes over a period of 5 years. Now friends, as you can see, for the 5 years we are given the consumer price index, wholesale price index, that is WPI, and GDP growth rate as well. Now, based on the data, which economic phenomena is most likely occurring and what policy response should a central bank prioritize to control the situation? And the options given to you are these. That is, first option is demand pull inflation, And the policy response is increase interest rates to curb excessive demand. Then second option is cost pull inflation and reduce taxes on essential commodities to ease supply side pressures. Then third option C is stagflation and focus on structural reforms to improve productivity while managing inflation. And last option D is hyperinflation. And the policy response is implement monetary tightening to reduce money supply rapidly. Now friends, this is a very good question. So before solving, let's first understand what all these three economic data measure means. Now first is CPI, that is Consumer Price Index. Friends, this measures the change in price level of a basket of consumer goods and services. Now in our case study, CPI is steadily increasing each year, which indicates rising consumer prices and persistent inflation. The next is WPI, that is Wholesale Price Index. Friends, WPI tracks changes in price at wholesale level, that is prices before products reach consumers. Now, similar to CPI, WPI is also consistently rising in the given table, which indicates that inflationary pressures exist throughout the supply chain. And lastly, we have GDP growth rate. Now, this measures the economic growth of the country. Friends, please notice in the case given, the CPI and WPI are increasing, but the GDP is constantly declining each year. That is from 6.2% in year 1 to 3.8% in year 5. Now, this suggests a slowdown in economic activity. So friends, the scenario described in the table is the classic case of stagflation. Now, stagflation is a situation where the economy experiences stagnant growth, that is high inflation and often high unemployment simultaneously. The data clearly shows that while inflation, that is both CPI and WPI, is rising, the economic growth, that is GDP, is declining. Now the data clearly shows that while the inflation, that is both CPI and WPI, is rising, but the economic growth, that is GDP, is declining, which is a typical symptom of stagflation. So the correct option for the given question is option C. But friends, why the case is not demand pull inflation or cost pull inflation as given in options A and B? So please note, demand pull inflation occurs when aggregate demand exceeds aggregate supply and thus leading to price increases. However, in the given case, the economy is slowing down and demand is not growing robustly, which contradicts the idea of excessive demand driving inflation. The next, cost push inflation results from rising costs of production inputs, which are then passed on to the consumers. Now in our case, although the rising WPI in the table suggests some cost push elements, but the overall economic scenario points more towards stagnation rather than supply side issues. Lastly, why not hyperinflation as mentioned in option D? Now friends, hyperinflation refers to extremely high and accelerated inflation, which is often above 50% per month. Now please note, the inflation rates given in the table are moderate and persistent, but not at the level of hyperinflation. So we got the correct answer as C here. But friends, this question also asks about policy response. Now friends, in stagflation, traditional monetary policy tools like raising or lowering interest rates are less effective because they either first address inflation but worsen economic stagnation. And second, they stimulate growth but increase inflation as well. So the correct approach involves focusing on structural reforms that can boost productivity, improve efficiency, and address supply side constraints. This could include investing in infrastructure, reforming labor market, or enhancing business environments, while also managing inflation through selective measures like price control or targeted subsidies. So option C here is correct because it accurately captures the phenomena and suggests the most appropriate response to long-term economic stability. Then next is a numerical from the concept of ISLM model, which is hot favorite of IRBF people. So please watch this next question very carefully. And the question goes like this. Suppose an economy is in equilibrium based on ISLM model. The following functions describe the economy. Now these functions are given to you, that is consumption function is given as C equals 120 plus 0.75 YD. Then investment function is given as I equals 200 minus 20I. Then government expenditure function is given as G equals 100. Then lump sum tax is given as T equals 80. Then money demand function, that is MD equals 0.25y minus 10i, and finally money supply functions, that is MS, is given as MS equals 250. Given the above information, what is equilibrium interest rate, that is I, and income level Y? Now these answer choices are given to you. Now friends, if you don't know anything about ISLM model, then just watch this video. I have beautifully explained this model in the simplest form. And once you watch that video, ISLM model questions will be a cakewalk for you. Now this data and equations of consumption, investment, expenditure, etc. which are given here is a standard form which you find in most questions. The basic approach of finding equilibrium point in ISLM model is to first find the IS equation and then find the LM curve equation and then equate both these, that is IS equals LM at equilibrium, to find the required values of equilibrium interest rate I and income level Y. Now those of you who don't know the full form of ISLM model, now here IS stands for investment savings and LM stands for liquidity preference money supply. Now friends, IS curve is derived from the equilibrium condition in goods market as Y equals C plus I plus G. So let's substitute all the values of C, I and G from the question given. That is, consumption function C is given as 120 plus 0.75 YD, where YD is basically disposable income and is given by YD equals Y minus T. And T, that is taxes, are given as 80 in our question. So YD equals Y minus 80. So the consumption function finally becomes 120 plus 0.75 multiplied by Y minus 80, which equals 120 plus 0.75 Y minus 60. And on solving this, you will get 60 plus 0.75 Y. And then investment function I is given as 200 minus 20I, and government expenditure G is given as 100 here. So friends, let's substitute all these values in the equation here. So the equilibrium in goods market becomes Y equals C plus I plus G, that is Y equals 60 plus 0.75 Y plus 200 minus 20I plus 100. And on simplifying and solving, you will get Y equals 1440 minus 80I. And this is nothing but the IS curve equation. After this, let's derive the LM curve equation. So the LM curve is derived from the equilibrium condition in the money market as MD equals MS. And money demand function, that is MD, is given as 0.25Y minus 10I, and money supply function, that is MS, is given as 250 here. So the equilibrium in money market becomes 0.25Y minus 10I equals 250. And on rearranging, you will get Y equals 1000 plus 40I, which is nothing but our LM curve equation. Then next we can find the equilibrium by solving both these equations of IS and LM curves. So let's equate the IS and LM curve equation as 1440 minus 80I equals 1000 plus 40I. And on solving for I, we get 3.67%. Then next, let's substitute the value of I equals 3.67 into any of these equations. Let's do it in the equation of LM curve. That is Y equals 1000 plus 40 multiplied by 3.67 equals Y equals 1146.8. So friends, we get the equilibrium interest rate I as 3.67% and equilibrium income level Y as 1146.8. Thus the correct option for the given question is option C. Then next friends, if you are enjoying the content and found it useful till now, then don't miss out to like this video, since this tells me that you are loving the content and it also motivates me to make more such awesome content. So just hit like and also subscribe this channel. Next, let's move forward with our mock test. And the next question covers the concept of business cycle. And the question goes like this. A company operates during the depression phase of a business cycle is witnessing extremely low aggregate demand and persistent deflation. As a result, it is forced to operate below its break-even point. Which of the following should be company's primary focus to weather this phase and prepare for eventual recovery? And these options are given to you. That is, first option is launching high-cost innovative products to attract niche markets. Then second option is enhancing credit sales to boost short-term liquidity. Then third option C is securing long-term contracts at lower margins to ensure consistent revenue. And last option D is investing in heavy capital expenditure projects for future growth. Now friends, the correct option for the given question is option C, that is securing long-term contracts at lower margins to ensure consistent revenue. Now friends, as you all know, this is the basic business cycle curve. So during the depression phase, aggregate demand is low, prices are falling and consumers' confidence is weak. Now to survive this, companies need stable cash flow even at lower profit margins. For this, long-term contracts, though less profitable, provide consistent revenue and help maintain liquidity. Friends, this strategy ensures that a company can cover fixed costs and survive until the recovery phase begins. Now let's see why other options are incorrect. Friends, option A says launching high-cost innovative products to attract niche markets. Now, introducing high-cost innovative products during a depression is really a risky strategy. During this time, consumer spending is low and there is little appetite for premium products. Most customers are more focused on essential purchases rather than niche or luxury items. Additionally, the costs associated with developing and marketing innovative products are high and there is no guarantee of enough demand to justify the investment here. The next option B says enhancing credit sales to boost short-term liquidity. Friends, while offering credit sales can boost immediate sales, but it increases the risk of defaults during a depression. The customers are in fact more likely to struggle with repayments in an economic downturn, leading to more bad debts. Moreover, enhancing credit sales does not address to the root cause of low aggregate demand and could worsen a company's financial health if a significant portion of sales is on credit here. Lastly friends, option D says investing in heavy capital expenditure projects for future growth. Now here, investing in capital expenditure during a depression is a foolish decision. The low demand environment means that an additional capacity created would likely remain underutilized. Additionally, during a depression, financing large capital projects is difficult due to tight credit conditions and lower internal cash flows. So friends, I hope you got this question and also how the question can be asked from this chapter. Many students just leave this business cycle chapter assuming it's of no use with hardly 2-3 pages, and so they assume it as not important. The next question is from very important FRBM Act, that is Fiscal Responsibility and Budget Management Act. And the question goes like this. The FRBM Act, amended in 2018, introduced a revised fiscal deficit roadmap targeting a fiscal deficit of 3% of GDP in the medium term. However, due to economic impact of COVID-19, the government had to invoke the escape clause and allowed higher deficits. In 2023-24, the fiscal deficit target is set at 5.9% of GDP. Assume the government successfully achieve its revenue and disinvestment targets and an expected windfall occurs due to unexpected GST buoyancy. In this situation, which of the following fiscal targets is most consistent with returning to original FRBM roadmap while maintaining a growth-enhancing public investment? And these options are given to you, and the first option is channeling the windfall towards reducing the fiscal deficit to expedite FRBM targets. Then second option is enhancing public sector wage bills and subsidies, leveraging the windfall gains. Then third option C is maintaining the deficit target at 5.9% while reallocating the windfall to new welfare schemes. And last option D is increasing capital expenditure in high multiplier sectors while moderately reducing the deficit target. Now friends, the correct answer for the given question is option D, that is increasing capital expenditure in high multiplier sectors while moderately reducing the deficit target. Now friends, this strategy strikes a balance between fiscal prudence and growth-oriented spending. Higher multiplier sectors such as infrastructure generate significant economic returns by enhancing productivity and creating employment. So by channeling additional revenues towards these sectors, the government not only increases growth but also enhances future revenue streams. Also note, a moderate reduction in fiscal deficit demonstrates the government's commitment to fiscal consolidation, thereby maintaining investor confidence while addressing long-term macroeconomic stability as well. Next, let's see why other options are incorrect. Now, option A says channeling the windfall towards reducing the fiscal deficit to expedite FRBM targets. Friends, while this measure would improve fiscal metrics, but it will miss the opportunity to stimulate growth in short run as well, especially in a recovering economy. Solely focusing on deficit reduction may hinder public investment, which is essential for sustaining long-term growth. The next option B is enhancing public sector wage bills and subsidies leveraging the windfall gains. Friends, here increasing subsidies or wage bills could lead to inefficient spending and also potentially worsening inflationary pressures. Now friends, this option in fact contradicts the objective of fiscal sustainability. Then lastly, option C says maintaining the deficit target at 5.9% while reallocating the windfall to new welfare schemes. Friends, please note, while welfare schemes are important, but diverting all windfall revenues to these programs without focusing on growth-oriented investment might lead to higher recurring expenditures and thus placing additional pressure on future budgets and debt levels. Thus, the correct option for this question is option D. So friends, I hope the question as well as explanation is clear to you. The next question is based on the concept of assessing economic welfare using multiple metrics. And the question goes like this. A country has seen significant growth in its GDP over past decade. Yet questions remain about whether this growth has translated into improved welfare for its citizens. The country's metrics are as given below. Now friends, we are given these 6 metrics, that is, first one is nominal GDP for 2014-15 and 2023-24. Then next we are given real GDP. Then next we are given Gini coefficient, then Human Development Index, that is HDI, then poverty rate percent, and lastly environmental degradation index. While GDP has more than doubled, the Gini coefficient has worsened, indicating growing income inequality, and the environmental degradation index has also increased. Which of the following statements best captures the complexity of relying solely on GDP to assess economic welfare? And these options are given to you. That is, first option is the increase in GDP suggests significant improvement in living standards irrespective of rising inequality and environmental concerns. Then second option B is although GDP growth is impressive, rising inequality and environmental degradation indicate that welfare may not have improved proportionately. Then next option C says the HDI index confirms that the GDP growth has indeed translated into better welfare for its citizens even with rising inequality. And lastly, option D says the reduction in poverty rate suggests that the GDP growth has primarily benefited the lower income segments, making other indicators less relevant. So friends, as you all know, GDP growth is often seen as a key indicator of economic progress. But please note, it doesn't fully capture the true welfare of a country's citizen. In the given case scenario, although nominal GDP has more than doubled from 50,000 billion rupees to 120,000 billion rupees, the rising Gini coefficient from 0.35 to 0.45 indicates increasing income inequality. Now this shows that the benefits of the growth may be concentrated among a smaller section of society only, and thereby leading to a widening gap between rich and the poor. Additionally, the environmental degradation index has also worsened from 0.50 to 0.70, and this is highlighting that economic activities are contributing to environmental harm, which can have long-term negative impacts on public health and sustainability. On the other hand, there is slight improvement in Human Development Index, that is HDI, from 0.75 to 0.80. And a reduction in poverty rate, that is from 22% to 18%, are positive developments. And these are in fact some benefits reaching lower income groups. However, these gains are nullified by rising inequality and environmental costs. Therefore, relying solely on GDP as a measure of welfare is misleading. Now friends, a more holistic view considering economic distribution, environmental sustainability, and human development is essential for accurately assessing overall society welfare. So as far as this question goes, the correct option is option B. So I hope you got the explanation. If you have any confusion, then please post your doubt in the comment section. The next question is based on the concept of calculation of primary deficit, and the question goes like this. Given the following data about a fiscal year, now revenue receipts are given as 70,000 crores. Next, revenue expenditures are 1,20,000 crores. Capital receipts are 50,000 crores. Then capital expenditure are 80,000 crores. And lastly, interest payments are given as 20,000 crores. Now, what would be primary deficit? And these options are given to you. Now friends, primary deficit is calculated as primary deficit equals fiscal deficit minus interest payments. So we first need to calculate fiscal deficit here. And you all know fiscal deficit equals a revenue expenditure plus capital expenditure minus revenue receipts plus capital receipts. So let's plug in all these values here. That is fiscal deficit equals 1,20,000 crores plus 80,000 crores minus 70,000 crores plus 50,000 crores. And on solving this, you will get fiscal deficit as rupees 80,000 crores. Next, let's calculate primary deficit. Now primary deficit will be 80,000 crores minus 20,000 crores, which is basically our interest payments, equals 60,000 crores. So as far as this question goes, the correct option is option A. The next question is again from business cycle concept, and the case study goes like this. A manufacturing firm in the electronic industry has experienced a rapid increase in sales over the past few quarters. However, the latest quarterly report indicates that the inventory to sales ratio has started to rise, signaling a slowdown in sales growth. In response, the firm has decided to adjust its production levels. Considering the business cycle phase the firm is likely in and the typical firm behavior during this phase, what should be their most appropriate action? And these options are given to you. Now first option is increase production to take advantage of the anticipated sales growth. Then second option B is maintain current production levels to avoid potential layoffs and other associated costs. Then third option C is decrease production to restore the inventory to sales ratio to its desired level. And last option D is invest in new capacity assuming the expansion will continue. Now friends, this question is based on the concept that inventory to sales ratios typically increase late in expansions when sales slow and decrease near the end of contractions when sales begin to accelerate. And thus firms decrease or increase their production to restore their inventory to sales ratio to their desired levels. So friends, the correct answer for the given question is option C. That is decrease production to restore the inventory to sales ratio to its desired level. Friends, this action is appropriate because a rising inventory to sales ratio indicates that sales are slowing down relative to inventory levels, which typically happens during the later stages of an economic expansion or at the peak of the business cycle that is here. So by reducing production, the firm can prevent an oversupply of products, which in fact could lead to financial strain if demand continues to weaken. Then next, let's see why other options are incorrect. Now option A says increase production to take advantage of the anticipated sales growth. Now friends, this option is incorrect because here it assumes that sales will continue to grow. However, the rising inventory to sales ratio is showing that demand is slowing and not growing, thereby making increased production likely to worsen the situation. The next option B says maintain current production levels to avoid potential layoffs and other associated costs. Friends, while this option may seem good, but maintaining production at current levels could result in excess inventory, which is tying up capital and thus leading to inefficiencies. So it's better to adjust production in response to changing demand. Lastly, option D says invest in new capacity, assuming the expansion will continue. Friends, this option is incorrect because it assumes continued expansion. But in reality, the indicator suggests that the business is nearing or at its peak, making further investment risky and potentially leading to underutilized capacity. So friends, I hope the question is clear to you. Next, finally, we have reached the last question of our mock test, and this is based on the concept of interaction of monetary and fiscal policies. And the case goes like this. In a scenario where a country's government decides to implement a contractionary fiscal policy by reducing government spending on social welfare programs and increasing taxes, while the central bank simultaneously adopts a contractionary monetary policy by raising the policy interest rates, which is the most likely impact on the public sector, private sector, and overall interest rates? Now these options are given to you. That is, first option is the public sector will expand, the private sector will contract, and interest rates will fall. Then second option B is both the public and private sectors will contract and interest rates will rise. Then next option C is the public sector will contract, the private sector will expand, and interest rates will fall. And lastly, option D is the public sector will expand, the private sector will expand, and interest rates will also rise. Now friends, this question is simply based on this very important table which demonstrates the interaction between monetary and fiscal policies. Now the only thing you need to see in the question statement is contractionary fiscal policy and contractionary monetary policy. That's it. Now just see this first row. Friends, please note contractionary simply means tightening of policy. So when both fiscal and monetary policies are contractionary, the overall effect is a reduction in aggregate demand. The public sector contracts due to reduced government spending and the private sector contracts due to higher borrowing cost and lower disposable income from increased taxes. Also friends, interest rates will rise as a result of central bank's tightening monetary policy. So as far as this question is concerned, the correct option is option B. So friends, with this I wind up this video. I hope you found the content beneficial. Also, don't miss out to get your JAIIB Masters Pack from the links given in description to this video. You can also get individual books as well. So thank you, and I will meet you again in another video.